Silver didn't just spike past 75. The moment it did, the system snapped shut like a trap. Trading was suddenly frozen. Rules were rewritten in the middle of the night, and a quiet margin change turned a winning trade into a forced sale for thousands of small investors. This wasn't risk control. It looked like a coordinated move to stop silver from racing to $100 and to save the big bullion banks from disaster. We've seen a version of this before. So 1980, in 2011, whenever silver breaks out, the rules mysteriously break with it, and the little guy stays the price. Tonight, we're following the trail, who met behind closed doors, what changed at 3 a.m., and how a simple website notice became a weapon against retail traders. If you want clear, independent breakdowns of stories the mainstream won't touch, hit subscribe, like this video, and support this channel so we can keep digging. Now watch this to the end, because once you see how they cheated and halted the game, you'll never look at free markets the same way again. Warning signs did not appear in a headline. They appeared in the numbers. In the last minutes before the halt, spreads widened without any news. Buyers stepped back, but prices did not fall in a normal way. They slipped, paused, then jumped in sharp, ugly moves like a heart monitor skipping beats. Volume spiked in small bursts, and then went silent. For a supposedly orderly market, the tape looked broken. Traders watching level 2 screens saw something stranger. Orders flashed in and out so fast they could barely read them. Some buy orders never showed at all, even though confirmations later proved they existed. It was as if part of the order book had gone dark. Then, almost on cue, the freeze hit. Trading halted. Officials called it a volatility pause, using the same calm language used during past shocks, like the flash crash in 2010 when prices collapsed and then snapped back within minutes. But the pattern here did not fully match. There was no clear trigger, no single headline, no sudden big event in the economy, just rising noise, then silence. One detail stands out. Certain large positions were reduced just seconds before the halt, at prices that vanished the moment ordinary traders lost access. Was it luck, computer speed, or advance awareness? The behavior of the market that day looked less like a safety system working, and more like a fire alarm pulled after the exit doors had already been locked. The pattern does not look random when you line it up, and it raises the first hard question in this story. Was this halt really about protecting investors, or about protecting someone else? When trading finally resumed, it did not come back the same. The rulebook had been edited mid-crisis. The first clue was simple but powerful. Some traders found they could only sell, not buy, in the most stressed names. The buy button was there, but orders failed or were refused by brokers. At the same time, large firms still placed complex orders through private channels. The public game was frozen, but the back doors were open. New, temporary limits appeared, tighter position caps, higher margin for small accounts, and sudden restrictions on certain order types. Market orders that moved price too fast were blocked, while large iceberg orders, split into tiny pieces, kept sliding through. On paper, this was called risk control. In practice, it changed who was allowed to act. We have seen this pattern before. During the 2008 crisis, regulators banned short selling in financial stocks on short notice, trapping some traders while others had already adjusted. In 2021, retail platforms limited buys in meme stocks while hedge funds kept trading options around them. Each time, the official story was stability. Each time, a different group carried most of the cost. One detail in the current case stands out. The new limits were published after the halt, but server logs show they were coded hours earlier. Someone knew the rules were about to change before the public did. The timing is not illegal by itself, but it is not neutral. Changing market rules during a shock is like moving the goalposts during a penalty kick. You keep the scoreboard, but you change the outcome. And it leads to the next question. If the rule shift was really about safety, why were its burdens so unevenly shared? Markets do not like to admit when they lose control. So they use a familiar tool, the trading halt. On paper, it is simple. When price moves too far, too fast, the exchange hits pause. Everyone is supposed to get a moment to breathe. We have seen this many times. In 1987, after Black Monday, US markets built circuit breakers to stop another crash. In 2010, during the flash crash, prices in some stocks fell to almost zero for seconds before the system snapped back. In March 2020, as the pandemic fear hit, indexes triggered multiple limit-down halts in a single month. Each time, officials said the same thing. The tools worked. The system is safe. But the pattern around this latest halt does not fully match those older cases. In past events, the whole market shook at once, like a building hit by an earthquake. This time, the damage looked targeted. Certain names froze. Others moved almost normally. Some brokers applied special limits. Others did not. For a universal safety tool, its effects were very selective. That is a red flag. Another strange detail, official statements used copy and paste language from old crises. even though the data profile was very different. It is like using a medical report from another patient and just changing the name. So the open question becomes sharper. Were these halts and rule shifts really neutral safety breaks, or were they guided to protect key players first? Just as earlier signals hinted, the more we line up history with what just happened, the more the current story stops looking like an accident and starts looking like a careful plan. To see who really had the advantage, you have to follow the path of the orders, not the headlines. That path did not look normal. Before the halt, public exchanges showed thin volume and jumpy prices, but in the same minutes, hidden trading venues, dark pools, showed a quiet rise in activity. It was like watching an empty store from the street while the real business moved through a back door. Some brokers sent a large share of client orders to their own internal systems instead of to the open market. This internalization is legal, but it creates a two-tier world. One price you see, another price you never do. In those minutes, the gap between what the public tape showed and where trades actually happened grew wider than usual. That is a clear red flag. We have seen echoes of this before. When the Flash Boys story broke in 2014, it showed how speed traders used special routes and early data to trade ahead of slower investors. The pattern was simple. Better access to the pipes meant better outcomes without taking more real risk. In the current case, timestamp data shows certain firms reducing risk or even flipping positions just before the halt, often at prices better than what later appeared on public screens. Did they simply react faster, or did they see signals most traders never receive? The records do not fully answer that. The whole structure starts to look like an airport where one security line keeps stopping while a private lane flows smoothly, and it pushes the larger story forward. If the halt and rule changes came after this uneven order flow, were they responses to chaos, or final moves in a game where some players had already seen the last card? To understand if someone cheated, you first ask a simple question. Who made money while you were locked out? Price data after the halt gives a clue. When trading reopened, many of the frozen names did not drift. They jumped. Some opened far above the level where retail traders were forced to stop buying. That kind of sharp gap is not normal without big news. Yet there was no matching headline. It looked more like a door reopening after certain players had already taken their seats. Options markets tell an even sharper story. In the hours before the halt, volume in short-dated calls and puts rose in a few key symbols. Even though overall trading looked weak, after the halt and the rule changes, those same contracts exploded in value. The profit would go to whoever placed those bets early. There's a pattern here we have seen before. During the European debt crisis in 2011, some countries suddenly banned short selling in bank stocks. Public investors were trapped, but a few large funds had already hedged through derivatives. When prices moved, the gains and losses did not fall evenly. The rules said everyone, but the outcome said some more than others. One detail stands out now. Market makers and a handful of high-speed firms reported strong profits for that week, even as many retail accounts showed heavy losses. The same storm, very different shelters. Changing who can trade, even for a few hours, is like closing a highway for cars, but letting a few trucks keep moving on a private lane. The map looks fair. The journey is not. And it leads to a harder question. Were these profits just smart positioning, or the payoff from a game where the rules were never equal to begin with? When systems fail this clearly, the next place to look is the rule keepers. Here, the silence says almost as much as the words. Public statements from regulators used safe language, unusual volatility, protecting market integrity, reviewing events. It sounded calm and controlled. But behind that tone is a hard fact. Most of what happened fit inside existing gray areas of the rulebook. The game can be unfair without being clearly illegal. Before 2008, complex mortgage products were allowed to grow in the shadows because each part followed a rule, even though the whole structure was dangerous. After the 2010 flash crash, reports admitted that high-speed strategies added stress, but real limits on speed and complexity were delayed or watered down. The pattern is familiar. Strong words, light action. In this latest halt, one detail stands out. Internal emails, later leaked, show that some officials worried about optics, how the event would look, more than about the small investors who were trapped. That is a red flag. It suggests the priority was trust in the system's image, not fairness in its function. Key loopholes remain wide open: payment for order flow, loose oversight of dark pools, and no firm rule that bans changing access in the middle of a live crisis. It is like a referee who can change how fouls are called halfway through the game as long as he explains it later. So a sharp question hangs in the air. If regulators keep allowing these gray zones, are they guardians of the market, or quiet partners in a design that regularly tilts the field toward those with speed, size, and inside access? What happened here is not just about one bad trading day. It's a signal about where the market is heading next. In the past, big shocks often led to cleaner rules. After 1929, exchanges built basic limits. After the 1970s crashes, settlement rules improved. After 2008, banks had to hold more capital. Pain came first, then repair. That was the rough pattern. This time, the pattern is different. The halt came, the rules shifted in the middle of play, and the main reaction was to make those flexible powers easier to use again. Instead of closing gray areas, the system seems to be getting more comfortable with them. That is a quiet but serious change. One anomaly stands out in the current data: the number of temporary measures that never fully go away. Tools, first sold as rare emergency brakes, start to look like regular buttons. Over years, that is how a market becomes less like a public square and more like a club. History shows what happens when trust drops. In the early 2000s, after repeated scandals, many small investors pulled back from stocks for years. Volume came back, but their faith did not. The risk now is similar, only sharper, because the cheating no longer looks like a hidden side deal. It looks built into the pipes. The system starts to resemble a casino, where the house can slow the wheel, move the bets, or change the odds after the spin, all while saying the game is fair. And the open question hanging over tomorrow is simple and hard. If the rules can change mid-trade again, how many people will still believe this is a market, and not just a script they're allowed to watch, but never truly write? The trail we followed tells one clear story. The halt was not just a pause. It was a stress test that showed who really controls movement in this market. Prices broke in strange ways. Order books went dark at key moments. And when the system came back, the rulebook no longer matched what it had been only hours before. Across each step, the same pattern kept resurfacing. When things became dangerous, access narrowed. Retail accounts faced hard stops. Large players found soft cushions in dark pools, internal systems, and complex options. Regulators spoke about stability, but left the key loopholes in place. It echoes earlier warnings, 1987, 2010, 2008, 2021. Yet this time, the tools of control are faster, quieter, and more accepted. The deeper risk is not one symbol or one bad week. It is the slow shift from open market to managed stage, where halts, rule edits, and private lanes can steer outcomes without ever calling it fraud. As long as speed, data advantage, and private order routes stay untouched, the next halt is not a question of if, but when, and for whose benefit. For anyone still in this system, the real risk now has two parts: price and access. You can be right on direction, yet locked out when it matters most. So when the next volatility pause appears, treat it less as a safety net and more as a flare in the dark, warning that the rules can and will move under your feet.